If you're a skilled worker here in the US on an H-1B visa, you're probably making a pretty good salary, but you're also dealing with the high cost of living and trying to put a decent amount into savings.
For sure.
But if that cash is just sitting there, you know you're losing money to inflation every single day. You need to make it grow. And that leads to this huge, really high-stakes question. Can you, as a foreign national on an H-1B, legally and safely get into the U.S. stock market without, risking your entire legal status?
It's the ultimate tightrope walk, really. You have this income you've earned and you're trying to tune it into passive wealth, but all the rules that govern you being here are laser focused on you keeping your full-time job.
A financial mistake hurts, but a legal mistake could mean getting sent home.
Exactly. The risk is just immense.
That is exactly why this deep dive is so important. We've pulled together sources on USCIS immigration rules, the very tricky tax side of being a resident alien, and maybe most importantly, the cold, hard financial facts about short-term trading.
Our goal today is to cut through all that fog and give you a clear guide to growing your money without jeopardizing your status.
So where do we start?
Well, let's start with the good news. The baseline fact is, yes, H-1B holders absolutely can invest and trade stocks in the U.S.
Okay, so it's not illegal.
Not at all. The real complexity, all the confusion, it's all about where you draw the line between acceptable, passive investing and what looks like unauthorized active work.
Let's draw that line then.
So first, the green light. We have to be really clear here. There are absolutely no rules that say an H-1B visa holder cannot buy, sell, and hold stocks in the U.S. market.
Just like any other investor.
Just like any other retail investor.
Yeah.
This is all considered investment income, not earned income. That's the key distinction.
The sources call this general delivery-based stock trading. That sounds a little jargony. What does it actually mean in practice?
I think the clearest way to think about it is through the tax code. The safest, most ideal way to invest is to buy an asset, a stock, or whatever, and hold it for long term.
And long term specifically means, what, a few months?
More than 1 year. That 1 year mark is the absolute linchpin.
Why is that so important?
Because that's how the IRS defines a long-term capital gain. And those are taxed at a much lower rate. But more than that, that long-term mindset just inherently keeps you in the safe zone, acting as a passive investor.
Right. You're letting your money work for you, not making trading your work.
Exactly. You're not a day trader, which requires constant, intense activity.
Okay, so let's get into the nuts and bolts. To do any of this, you need a brokerage account. Schwab, Fidelity, Robinhood, whatever. What do you need to open one as an H-1B holder?
Well, it starts out pretty much the same as for a U.S. citizen. You have to have a valid Social Security number. That's non-negotiable for any taxable brokerage account.
Okay, SSN. Got it. What else?
After that, the brokerage just needs to confirm that you're legally allowed to be in the country.
So, immigration documents.
Yep. That means a copy of your passport, a copy of your H-1B visa stamp, and this is a big one, a copy of your I-94 arrival and departure card.
That I-94 proves your current legal status, right?
It's the key piece of evidence. And then you need the standard stuff, like a utility bill or a lease, to prove you have a U.S. residential address.
Yes.
And here is a really crucial legal point that every single source hammered home. The trading must be, and I'm quoting, for you and from your account.
What does that mean? It sounds obvious.
It does, but it means you can't be pooling money with family back home or managing an account for your cousin or something. It has to be your money, your decisions, all into your SSN.
Because managing it for someone else would be work.
A definitive violation of your work authorization, no question.
Okay, so long-term investing is clearly fine. But now we have to get into the high-risk, high-stress gray area, day trading. The whole point of your H-1B status is maintaining that full-time job with your sponsor. You are here to do that job.
And that's the core of the conflict, isn't it? Day trading, buying and selling the same stock in the same day, it's incredibly demanding.
It's a job.
The sources all describe it that way. It takes a lot of time and effort and is often compared to being a full-time job in itself.
So if an immigration officer sees someone spending, 6 hours a day staring at charts and making dozens of trades, that looks like a job.
It really does. And their main concern is whether you're engaging in unauthorized work. Now, to be clear, USCIS has never issued an official rule that bans stock trading.
They can't? Really? People have to manage their own money.
Of course. But the guidance is indirect. It basically says that your trading activities can't get in the way of your main full-time job. The time you spend on it cannot be equal to a full-time role.
So it's a judgment call. Does this same logic then apply to other, volatile things like options trading or Forex?
100%. The thing you're trading doesn't matter. It's the level of activity. And options and currencies are often even more volatile and require faster decisions.
So doing it occasionally is fine, but if it becomes your main focus, you're in the danger zone.
You are pushing deep into the risk zone.
This brings up a really interesting technical point. If someone on an H1B does a bunch of high-frequency trading and actually makes good money, how does the government even find out? Like during a visa extension or something?
This is where it gets really nuanced, and it's why we call it a gray area instead of a flat-out ban. It comes down to the IRS forms.
Okay.
When USCIS reviews your case, they're looking for signs of unauthorized compensation. So that means W-2 forms from jobs you're not supposed to have, or 1099 NEC forms that say you worked as a freelancer.
Those are giant red flags.
Immediate, clear red flags. But trading profits don't show up on those forms.
So where do they show up?
They show up on your tax return on Schedule D in Form 8949, and the title of that form is literally Sales and Other Dispositions of Capital Assets. It reports a financial transaction, not that you performed a job.
I see the difference. A W-2 means you had an employer. A Schedule D means you sold something you owned.
Precisely. So even though the activity might feel like a job, the paperwork doesn't scream illegal work.
So that's why you hear stories of people getting extensions even with big capital gains on their tax returns.
That's why, but, and this is a huge but, this is not a legal loophole. It just means it's harder to flag automatically. If USCIS has any reason to believe you're spending your days trading instead of working, they can absolutely deny you.
The bottom line here is you have to be so careful. Talk to an immigration lawyer, talk to a tax consultant. Make sure your activity level is nowhere near what could be called a full-time role.
You have to. The ambiguity is just too high to risk it.
And before anyone even thinks about testing those limits, we need to talk about the other risk. The one that's way more immediate and, honestly, almost certain, the financial risk.
Yes.
Even if USCIS personally gave you a green light, the odds of actually succeeding at day trading are, well, they're terrible.
They're devastating. I mean, the data on this isn't just pessimistic, it's brutal. The sources are unanimous. Day trading is exceptionally challenging.
So give us the numbers. What percentage of people who try this actually make money?
The estimates are just dismal. Most studies suggest only about 3 to 20% of retail day traders make any profit over time.
So at best, an 80% failure rate.
At best. Some of the most sobering data suggests that up to 95% of active day traders lose money.
95%. And what about the average return?
One study put the average net annual return for a day trader at a loss, negative $750.
So you're not just failing to make money, you're actively lighting it on fire. Why? Why is it so hard?
It's structural. First, look at who you're competing against. You, as an amateur, are up against high-frequency trading firms. These are giants with algorithms making millions of trades a second.
They see the market before you do.
Literally. They have latency advantages measured in milliseconds, and that's enough to skim all the profit. You're just reacting to moves they already made.
And the market itself is just chaos day to day.
It's pure noise. It's driven by news, by emotion, fear, and greed, not by the stable fundamentals you see in long-term investing. It takes incredible discipline to not get swept up in that.
Which brings us to our own psychology, right? The mental traps.
Oh, absolutely. The sources point to all the classic biases. There's loss aversion, where the pain of a loss makes you hold on to a losing stock way too long.
And you sell your winners too early just to lock in a small gain.
Exactly. And then there's FOMO, fear of missing out, which makes you jump on a hot stock right at the peak, just before it crashes.
And if you start treating this like a job, you run into actual regulations like the pattern day trader rule.
The PDT rule.
Yeah.
Yes. AVMO says if you make 4 or more day trades within 5 business days in a margin account, you are flagged as a pattern day trader.
And what happens then?
The consequences are immediate. You are required to keep a minimum of $25,000 in your account at all times.
$25,000.
Yes. And if your balance drops below that, even for a day, you get a margin call and your account is restricted for 90 days. You're locked out.
For a lot of H1B holders just starting to build capital, that's a massive barrier. The risk of dipping below that and having your funds locked is huge.
It makes active trading almost impossible for most. So the legal gray area is almost beside the point when you factor in the near certainty of financial loss and that $25,000 wall. The risk reward is just completely broken.
So let's pivot. Let's get back to the safe, legal, and statistically winning path, long-term investing.
Yes. The goal should be building wealth steadily through passive diversification, not through high-stakes gambling.
Diversification being the key. Don't put all your eggs in one basket.
Especially when your main income is a single salary. For new immigrants, the best strategy is something consistent, low cost, and low effort.
The sources all point to things that give you automatic diversification. So low-cost options like exchange-traded funds, ETFs, and mutual funds.
They are the ideal starting point. With one purchase, you can own a tiny piece of hundreds or even thousands of companies like the entire S&P 500. It takes zero expertise in picking stocks.
And for someone on an H1B with that steady, predictable paycheck, the most powerful tool is probably dollar cost averaging, or DCA.
DCA is a perfect fit. It just means you invest a fixed amount of money, say $500, on a regular schedule, like the first of every month, no matter what the market is doing.
It takes the emotion out of it. You're not trying to time the market.
Which is impossible anyway. When the market is high, your money buys fewer shares. When it's low, it buys more. Over time, that just systematically lowers your average cost and boosts your returns.
And beyond the stock market, there are other safer paths, a 401k, maybe buying a house, or even just certificates of deposit, CDs.
The 401k is absolutely critical. Contributions are pre-tax, so it lowers your tax bill now, and the money grows tax deferred. That's a huge advantage.
Okay, so as you start to build this wealth, you have to understand your U.S. tax situation. H-1B holders are usually considered resident aliens for tax purposes. What does that actually mean?
It's a fundamental shift for a lot of people. It means you are taxed on your worldwide income.
Worldwide, so everything, everywhere.
Everything. Salary here, rental income from back home, interest, capital gains. It doesn't matter where the asset is. If you're a U.S. resident for tax purposes, you report it all to the IRS.
And this brings us right back to the most important tax rule that should guide your whole strategy: the difference between short-term and long-term capital gains.
This is the final nail in the coffin for day trading, financially speaking. Short-term capital gains, that's profit on anything you held for 1 year or less.
Which is everyday trade.
Right. Those gains are taxed at your ordinary income rate. That can be as high as almost 40%. It just eats away your profits.
But if you hold that same asset for more than 1 year,
then it's a long-term capital gain. And those are taxed at a much lower rate, a maximum of 20%, and often less.
the tax code itself is giving you a massive financial incentive to just be patient.
It's unmistakable.
Yeah.
Hold your investments, you keep more of your money, and you completely avoid the time commitment that puts your visa at risk.
Given all this complexity, the final advice is pretty clear.
You absolutely have to consult a tax professional who specializes in filings for non-citizens. It's the only way to ensure you're compliant and getting the best outcome.
So to pull this all together, the two major takeaways from this deep dive.
First, investing in the U.S. market is absolutely allowed, and it's a great way for H1B holders to build passive wealth. But high-frequency, time-consuming stuff like day trading presents this really severe dual challenge.
On one hand, you have the immigration risk. You're in a dangerous gray area where you could be seen as violating your full-time work requirement.
And on the other hand, you have the overwhelming financial risk. And this is where I think it all connects. The core requirement of your visa is to maintain your primary stable job, right? That job is your financial bedrock.
Right.
And the academic data shows that up to 95% of day traders lose money. They perform worse than if they had just bought an index fund and done nothing.
So, that leads to the final provocative thought you should really consider. Why would you ever risk your entire legal status, the very thing that allows you to earn your salary, on an activity that is statistically, structurally, and psychologically designed to make you lose money?
The greatest risk to your wealth might not be a market crash. It might just be the decision to treat an almost certainly losing side hustle like it's a real job. The smartest investment is often the one that protects your ability to keep investing in the first place.